this life ain't fair. And I know that you're going nowhere. Well, don't blame me for what you've done, because I know that you are having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Well, don't you just walk away. That's when I'll say.
Welcome to the Clarified Realty Podcast, episode number 002. Thanks for coming back again and taking part in the start of what I hope will be an amazing community of people overcoming their fear and of the unknown and truly becoming courageous when it comes to the process of buying or selling real estate. Once again, my name is Tom Clary. I'm a licensed real estate agent here in the state of California. My office is in the gorgeous San Fernando Valley, more specifically the city of Calabasas. I was born and raised in the Valley. That's right. I'm one of those Valley boys, like for sure. And I really love working with both buyers and sellers to help them, find or even sell sometimes the home of their dreams. Also with me again today is my good friend and lender extraordinaire, Ron Bruno. Ron, how you doing this fine, beautiful day?
Tom, I'm doing great. Thanks for asking. Couldn't ask for a better fall weather here in sunny Southern California.
It is a gorgeous day out there, but we're in here with you because we got a lot of good information we want to get out to you today. Today is all about mortgages, and we're here with Ron. He's going to be our guest for today. Ron, why don't you go ahead and give the folks a quick refresher on who you are and why the hell they should be listening to you in the first place.
I am a direct lender with the Mortgage Bank Guaranteed Rate in Pasadena, California. My specialty is working with business owners, executives, professionals, and my greatest joy is helping first-time home buyers.
Nice. That's nice. And I enjoy that too. It's one of those nice things when someone has never gone through the experience and to actually take and, guide them through and to see that smile on their face when they get those keys. It is a great, great feeling. So yeah, I definitely understand that. So what's the latest, before we move on, what's any news out there shaking up the mortgage community?
Actually, there were a couple news articles in mortgage land this week. The Federal Reserve decided not to raise the federal funds rate in September.
Okay.
Interest rates, they dipped a tiny bit on the news, but mostly markets, they anticipated that the Fed wasn't going to move off of zero.
Right.
They do look at potentially at year end doing an interest rate raise, possibly in December. It's pegged at about 50-50.
Okay. Yeah, that's what I'd heard too. The interesting thing is now one of the things we will kind of glance at a little bit later on. We're not going to be able to go too deep into it, but we mentioned that the Fed in correlation with interest rates, but there really is no direct relationship. Why don't you go ahead and kind of go a little bit, not too deep into it, but let everybody understand that even though we talk about the Fed and interest rates changing, it's really not what drives mortgage rates in any direct way.
Correct. So what's our biggest indicator is obviously mortgage rates, right? So we look at I would say the biggest indicator is the 10-year Treasury note. So today it was pegged at 1.61%. When the 10-year moves, typically mortgage rates, they'll move in unison, but it doesn't always happen that way. Right. We look at the stock market. We actually also look at international news, right? So you may have heard some news about the Bank of Japan. Mm-hmm. They actually introduced a new monetary policy, and you won't believe this, but they actually introduced a policy where they had a target for their 10-year interest rates at zero.
That's crazy.
Zero.
That's insane.
Zero.
Yeah.
So that means that you can buy a mortgage, not a mortgage note, but you can go ahead and buy a 10-year note in Japan and you will earn nothing on it.
Wow.
What a deal, isn't it?
I'm saving up right now. That's, one of the things that, that is also a driver is mortgage bond yields, basically, in terms of watching, if someone's only yielding 3% off of it, then, usually people go to the stock market because there's probably, more, they're going to get more there. So, and then basically interest rates come down to get the people interested again in coming in and getting more loans. So it drives, it's really the mortgage bonds that really drive. But the Fed is a good indicator of the general health of the economy and kind of tells people where, well, I probably want to go to safety and going into bonds instead of going into the stock market, which is usually more volatile.
That's right. That's right. Yeah. When you look at monetary policy, when you have low interest rates, the Fed or any organization, what they're trying to do is they're trying to spur the economy, right? So they're trying to increase economic growth.
Right. Well, listen, before we go kind of too much off on a tangent there, talking about general economic policy, really what we're talking about today is mortgages. And we're in for a treat today. Ron is not only going to be my sidekick as usual, but he's also the guest as well. And I consider Ron to be one of the most informed and knowledgeable people I know when it comes to the area of mortgage lending. I've been lucky to work with him, to really see him in action. And please believe me when I say he is a wizard when it comes to getting loans closed. Not only do I have complete and utter confidence whenever I refer clients to him, but more importantly, and this is, I think, really germane to the conversation that we're having today, he has an incredible talent, for lack of a better word, for distilling all that complex and technical information regarding mortgages. How do you get approved for them? How do you work with the lender and getting conditions met, getting them closed? He can distills it into very easy to understand concepts. It really helps buyers to ease their frazzled nerves and keep their eyes on the prize, and eventually get them into the home. So I'm happy to have you here in that capacity, Ron. I mean, it's great to have you.
I'm sincerely humbled and touched by that description. I need a tissue.
Oh, Jesus! I'll go get some Kleenex. I mean, look. In a 40 or so minute podcast, it's going to be incredibly difficult to actually scratch that. It's going to be impossible to cover the entire topic of home loans and mortgages. But what we really want to achieve today is to go over the basic, what I like to call, quote unquote, pipeline of a home purchase, and where getting approved for a loan fits into that process. And, for selling home too, by the way, believe it or not, a lender can be a very big help to the seller and the selling process as well. So we'll get to that a little bit later in the podcast, but I sort of want to talk about shall I say, the back-assward way that buyers usually start the process of looking for a home. But don't get me wrong. I think it's not necessarily all their fault. By the way, it's sort of how we're trained in our culture to make purchases. The way we've got it set up is we tend to become slaves to the objects of our desires. It seems a little flowery language, but that's really the truth. Ron and I were talking the other day, and he brought up a really good analogy for what usually happens, and I think it's pretty dead on. Basically, think about a car dealership. When you go out shopping for a car, where does that process start? It starts in the showroom, right? I mean, you walk into that perfectly lit, slick-floored showroom, and there's that sexy cherry red Mustang or Maserati convertible, whatever, man. I don't know what the hell floats your boat, but it's just sitting there, and it's calling your name, right? It's your dream machine. You've wanted one like it, and ever since you saw that girl you liked in high school get in the front seat and drive away with the captain of the football team, that son of a bitch. Man, it whispered success in your ear for decades, and every minute you worked was leading you up to this moment. Well, then what happens? You can't just write it off the showroom floor and in the sunset, right? No. You go directly into where? A sales office. Ugh. It's tight and it's cramped. I'm not exaggerating when I say it's claustrophobic, right? And what happens? You start, quibbling over payments, negotiating over extras you never wanted in the first place. You just want to get the hell out of there, out onto your first road trip to Vegas in the brand new Lambo. But here's the thing, by that point, they've got you. They know that very few people are going to put up any sort of a fight. There's a very good chance that since you've already fallen in love, it would be unromantic to debate over terms. You get questions like, well, what type of monthly payment can you afford? I mean, is that literally the most despicable question you've ever heard? I mean, think about it. Oh, You can afford $500 a month? Great. I have an awesome 84-month loan at an interest rate that could only be considered usury and predatory, but it'll only be $500 a month. We'll make it work. Hey, and what does it matter? You're just mere minutes from driving that sexy piece of machinery off the lot, right? Well, the same thing goes for home purchases. I mean, time and time again, I'll be working an open house and I hear the same thing. It's unbelievable. They walk in, it's like, oh my gosh, we really love this house. It's everything we always wanted. You know what? We're going to make an offer. I'm like, fantastic. Hey, we can do that. Hey, that happens to be what I do for a living. We've got, 2 other offers on the table right now, but we're always open to hearing another one. Who's your lender? And then there's this pause.
Crickets.
Yeah. Ooh.
Yeah, I can do that.
That's
not
great.
bad. Yeah.
Like they know, this question was always going to come up, but they never thought it would happen so soon or something. They had been putting it off for as long as they could, like people not wanting to go to the dentist. Like it's so complicated and scary that they've avoided it. Well, we haven't really talked to one yet. Wah, wah, wah. Sad trombone. By that point, it's 100% too late. That perfect house of yours, the one that you can't live without, is going to one of the other 2 offers. There's little to no way that a lender is going to be able to jump through the hoops fast enough to make that happen. It's done. So what we're discussing today is really the process of putting one foot in front of the other as it pertains to real estate. I mean, Ron, you've got to have seen this happen a lot, right? I mean,
with weak agents and salesperson agents, I see it all the time.
Yeah.
I don't have the fortune where every realtor who calls me is as sincere and relationship focused as Tom.
No,
I know it's our Barney moment. I love you, you love me. Yeah, there we go.
Right.
I've had agents, and actually this happened this past weekend. Well, they'll call me on a Sunday, right?
Right.
So I'm out shopping with my wife. I get this frantic phone call saying, okay, we need to make an offer. We need to submit the offer by 8 a.m. I've got a new client. They had a lender before, but I really want them to send them to you. Right. So you got to make it happen. Can I have that pre-approval letter? $500,000. I swear they're great.
And you're going to take them just at their word for it, right? The agent's word for it.
Oh, of course. I want to earn the business.
Of course. We want to make our commission.
Exactly. I mean, who cares about who cares about details? And we can figure that stuff out. We're in escrow.
Absolutely.
I'm
cashing the check already.
That's right.
I'm buying the red Mustang.
It's a sale. Why would we ignore a sale? Why would we ever do that? Well, guess what? That's not what I do, right? What I do is I actually look at the file and I look at the client's financial picture and I look at it objectively, right? You know why? Do you know why, Tom?
Well, I know why. I mean, it's basically so that 20 days later, there's not some sort of enormous headache when they can't get approved for the loan.
Right. Because the underwriter looks at it objectively.
Yeah, exactly.
Right? They don't have a sale attached to this. So what we're going to do is I will look at I'll run their credit. Right? Mm-hmm. I'll analyze every page of that credit report. I will ask for their income. I'll look at their pay stubs. I'll look at their W-2s. I'll look at their tax returns. I will then go through, and if there's anything that I see in that particular file that has any question, I'll check the guidelines. Yeah. I'll look at other different loan programs that are out there, right? So I investigate all those things. And can you sincerely investigate every potential pitfall within a span of 12 hours? Not really. Right. I certainly do as best as I can. Of course. But if we start the process where the client comes to me before they're about to make an offer, we talk about what programs they can afford. We talk about what type of home they're looking for. And I'm able to investigate and ask questions. And sure, it may not be the results they're looking for in terms of what I tell them, right? So if they were thinking, $500,000 and I tell them they're pre-approved for $430, well, yeah, I mean, it's a little bit of a...
It's a disappointing thing to hear, but at the same point, it's reality. It's the truth.
Right, exactly. So guess what? There are homes that fit within that budget, right? Yeah. So you may have to adjust your expectations, but if your goal is home ownership, then here's a way, right?
Well, and another thing that I think you bring up a really good point of actually poring over these documents yourself, and a human being actually, a lot of people don't understand this, but from a lot of loan brokers, even bankers and all that, they basically get a form filled out, they pop it into a computer, it flies off into the internets, and it comes back basically as approved or not approved. It's like this automatic underwriting process, but it doesn't have anything to do with human beings. Right? So you could literally have a computer who doesn't understand the nuances of a person's situation basically saying, yeah, that's cool, we're good, let's go ahead and get the process started. Well, then it just leads to just a nightmare later on.
Exactly. I mean, there's a lot of loan officers out there. They're trying to be efficient. They're also trying to fill their pipeline, if you will.
Right.
But, just throwing something up against the wall and seeing if it sticks. I mean, first of all, I'm Italian and I think that's disgusting. Right?
I've actually tried it. It doesn't, it's not a great indicator of whether it's something is edible or not.
Not so much.
Yeah.
And you know what? I feel that same disgust for professionals that try to just push a deal through because of all of the people that are involved.
Yeah.
I mean, think about it, right? I mean, you're spending $500 on the inspection. You're spending anywhere between $400 to $1,000, depending on the property, for the you're looking at the appraisal, right? So you're already out $1,500 before the process even started.
Right. People don't, and we're kind of getting ahead of ourselves a little bit, but this is so important. There's money that's being spent all along the way, right? And that's money that person, that buyer is not getting back. If they hear on day 20 that loan is not going to go through, they're not getting the inspection money back. They're not getting the X, Y, or Z money back that they put out in order to absolutely.
Yeah, and not to mention the trail of tears, right? So you have the reputations of both agents on both sides of the transaction.
Right.
You have escrow, you have title, you have an insurance agent. Yep. All of these people count on you and depend on you. I mean, not to mention the underwriter, the processor, and anybody who's involved in the transaction.
Right. So, all right. Well, let's take it back a little bit. So let's literally start at the starting line, right? Let's imagine you're sitting on the couch with your significant other. You're winding down with a little glass of vino. You're watching The Voice, or
we
whatever.
like dancing. We like Dancing with the Stars.
You like Dancing with the Stars.
We do.
So you're the one.
That's right.
But you
two. My wife.
I'm sure there's more than that because unfortunately it's still in the air. But
26 seasons.
Oh my God! Please kill me. But you turn to your wife, husband, whatever, and you say, I think it's time that we buy a house. And they look at you and you're a little bit shocked. It looks like they agree with you. It's like, I think you're right. We do need to buy a house. Fantastic, right? You probably think, the next thing I'm going to say you do is you call me, right? You call a real estate agent. Nope. The first step, as I always say, is to educate yourself. We spoke about that in the first podcast. The way to overcome fear of buying a home, fear of anything, is to become educated. So don't be lazy. Get the knowledge you need to make sure you are not being taken advantage of or at the mercy of someone who is incompetent. When you start talking to mortgage brokers or mortgage bankers, they're going to know not to screw with you because you know the terminology. They can't pull the wool over your eyes. That you know the difference between a mortgage broker and a mortgage banker in the first place. Today's podcast is going to get you part of the way there, and mortgages will be a continuing topic here. Ron is here, and he's not going anywhere. But you need to find your own sources of information and knowledge, and trust me, they're out there. There are websites and books and YouTube videos. Just make sure you consider where the information is coming from. If there's some sort of a slant or they have a vested interest in you believing their information, be suspicious. At the end of the day, you need to take an ownership of your search. I mean, sure, that agent or that broker took advantage of you or whatever, but you chose them in the first place. So be informed, be knowledgeable, and put those professionals on notice that you know what the hell you're talking about. They're your expert, your Sherpa, like we talked about, but you're the boss. Never forget that, right? So, okay. So we got that step out of the way. You're now educated. You know what the heck you're talking about. Ron, why don't you go ahead and take our fictional couple down the road to getting a loan? First off, like I mentioned, what's the difference between a banker and a broker?
Well, Tom, there's actually 3 avenues that are out there, right? So door number 1, you have the national retail banks, regional banks, credit unions. Door number 2 are brokers, as you mentioned.
Right.
And door number 3 are mortgage banks.
Right.
Right. So a quick explanation is, let's call it national bank, right, for a retail bank. You walk into the branch or you call them on the phone and you meet with the loan officer, and the loan that you're going to get is actually a national bank loan. Right. It's pretty simple. Right. It's pretty vanilla. The loan, once it's in process, it's managed by multiple departments all over the country, and at the end you get your national bank loan.
Right.
Door number 2. Brokers, what they do is they don't actually fund nor underwrite any deals.
Right.
What they do is they package it. Right. So they package it, they send it to one of their financial partners, and out the other end comes the loan approval, and you get your loan. Right. Door number 3 is a mortgage bank. Right. Mortgage bank. You may have heard the term direct lender. Right. So a mortgage bank, and first of all, for full disclosure, guaranteed rate is a mortgage bank.
Okay.
Right. So what a mortgage bank does is all we do is originate loans. Right. So it means that we don't take deposits. There's no investment banking arm. All we're doing are originating loans that are out there. So, and all of the people that are working on your loan, we're all on the same team. Right. So what it means is you have the processor works for the mortgage bank. You have the underwriter that works for the mortgage bank, the funder.
Right.
And, in some cases you actually will have the servicer will also be the same bank.
And let me interject here, because why is that important? Here's the thing. If you're working with a mortgage broker, right, generally speaking, they're one dude who's sitting in an office and he has a chance of about going out to 100 different people to get the loan that he wants to get for you, basically, right? But here's the problem. Let's say something goes south on the loan, right? Well, he doesn't have a relationship necessarily with any of these people that he got a really great deal with for you, right? So he can't call up that underwriter that he works with every single day of the week and go, hey, dude, what's going on with this loan? I really need to fix this.
Right. So the loan officer, who is a broker, they're dealing with a salesperson on the other end because that's their representative. Right. They don't have that option of calling the underwriter because they don't work for the same company. Underwriters, you typically don't, you don't have that access. If you work for a company that like a mortgage bank, you do have that access, right?
That's great.
I mean, that's
it's
a
kind of
huge
the best
advantage.
of both worlds. I mean, you've got basically the kind of the feeling of the broker, but at the same time, that kind of personal, trying to find you the best thing. But at the same time, you've got these relationships with people that you can go directly to and fix problems.
That's right. And working in a mortgage bank, you also, we're all on the same team, right? We all have the same common goal, and that is to fund your loan. Right. So we're able to kind of push the file forward and have those hard conversations and talk to all the parties involved. And it's all about control. Right. It's all about creating the path, outlining what we're going to do, and making sure that we've plugged the loan into the right program with all the right parameters. But it's our job as loan officers to keep that file moving.
Right.
And if there's any issues, we just make the phone calls and we make the magic happen.
Wow. Well, here's another question I've got, because when folks are out there shopping, whether to go to a mortgage bank or a mortgage broker, whatever, what we just talked about, I have clients that come up to me and they say, well, I'm with Wells Fargo. And it's like, well, okay, so you talk to them, they're more, no, that's where my checking account is. That's where that's where everything is. Is there, I sort of know the answer to this question. That's kind of leading. But is there any advantage to going with your, credit union, with your, the place that you're usually stuck, doing your business?
Right. So, I get that question all the time, right? So if the only bank you have ever banked with and that is your preference and you will never go anywhere else, then go.
Yeah.
Right. There's I'm not here to force anybody into anything.
Once a Starbucks drinker, always a Starbucks drinker.
Exactly. I'm not going to say you have to go to Coffee Bean. Right?
Yeah, right.
But if you're open to looking at other options that are out there, you really want, and you mentioned this in the first podcast, right? You talked about the protector agent, right? And that's what I try to strive, is to be a protector lender, right? So what I do, and what I hope that my clients appreciate, is I'm not trying to plug them in a certain program that stretches them, right?
Right.
So I'll I'm not here to badmouth anybody in the industry, right? That there's wonderful loan officers at every level, at all of the various avenues, right?
It would make for interesting listening.
It would. It's true. It's true. Okay, so I'll pick on them,
No, okay.
right? So I'm gonna pick on them a little bit. So you go into, and this is just how it's all does. A lot of these banks are designed, right? So we'll pick on the national bank, right? So national bank, you walk in there, they actually have quotas. Did you know that? They actually have quotas on generating as many pre-qualifications as possible. They also have quotas on generating applications, right? And
Well, and by the way, I will name a name because it's actually in the news and it's out there. I mean, you look at the Wells issue where basically there was a quota that was going on inside of the branches where people were being told to create these not told to do the fictitious accounts, but basically were put under so much pressure to open accounts that basically they were putting fake accounts into people's accounts. So
that's right, and that's the reason why I don't work for a national bank, right?
Yeah.
Because I'm always looking for what's the best for my clients and what's the best for my professional partners, right? And when you have someone that has essentially a literal gun to their head that says you need to do X amount of applications and X number of pre-qualifications, you're going to speed through as many clients as you possibly can, right? Yeah. And so the difference, I'll just touch on this. A pre-qualification, what it means is it is a lender saying you sound like a qualified borrower.
Right.
So we're going to lend you the money provided that we've verified your income, your assets, your credit, and we've gone through the full underwriting decision.
Right.
Right? That's all there in the fine print.
Right.
Well, I don't believe in that. I don't believe in pre-qualifications because what are you doing, right? I mean, you could be lying over the phone.
Yeah.
You give your hopes up and you give it to the agent and then you lie to the agent and everybody in the process, they all are punished by the happy ears that you were able to give to that lender. And that lender, they're just checking a box, right? They're just hoping that one of those pre-qualifications comes back and turns into a loan and they can put it in their pipeline. Oh, good. At least I have my applications. Yeah. Okay. So I mean, I was able to only fund 5 out of the 20 loans that came in,
right.
But at least I threw it up against the wall and saw what stick. And that's what I believe is a pre-approval, right? So there's more steps, right? So yes, it's running credit. It's analyzing your income. And not just the number you give me, but actually looking at the tax returns and going through all the calculations and really getting a good understanding of my client's financial picture and analyzing those assets too, right? So there's all these different pieces that are involved. But as I mentioned before, there's so much on the line and at risk. I don't put my client's capital at risk if it means that all I have to do is just do a little bit extra work, and if my client needs to do a little bit extra work, because like I said before, that pre-approval, it is a license to shop.
Yeah.
And
let me I'm going to say kind of from my side of the story as an agent. If someone is shopping out there with a pre-qual, right, and they find the home of their dreams, right, it's pretty much that pre-qual letter is basically worth the paper it's written on. It's really not worth much. The other agent on the other side is going to take a look at that pre-qual letter and say, fantastic, where's the approval? At the end of the day, their obligation, the seller agent, their obligation to their client is to make sure that for the 30, 45 days that you're in escrow, that you can sleep at night, that you've basically made the right decision to back the right horse. And when someone is showing up with a pre-qual, that is literally the smallest amount of comfort that you can give someone.
Absolutely. And
it's a spectrum. It's let's say that, that's the lowest, cash being highest, right? Where literally there's a bank account with the full amount of what the person is saying they're going to pay for your house. That's where your confidence spectrum is. Pre-qual, it's a step, but it's pretty much almost useless.
Right. And from a loan officer's perspective, the best you can have, the scenario you can have in that situation is that, okay, yeah, your feet is to the fire and you better come up with and run the automated underwriting system and the findings and all of those things and get it to the agent, because they're probably going to cross-qualify you, which means that the selling agent, so the one who's representing the seller, they will, we all have relationships, right? So you would actually, in this, transaction, you would actually, Tom would call me and say, will you cross-qualify this offer? Which means that I am actually looking at the credit, I'm going through all the documentation, and if it's a weak loan officer, game on.
Yeah.
Game on, right? Because what I'm going to do is if that person is potentially qualified, I'm going to offer them my best rate, I'm going to give them the program, and I'm going to get the deal.
Yeah.
Right?
Right.
So, if you have a loan officer that they rely on pre-qualifications, your offer could be just completely rejected, right? And B, if they do accept it, you're going to go through a pretty arduous process of having it cross-qualified, and C, you might not end up with the lender you had in the first place.
Right. And also, I think it's one of the things I want to bring up right now is basically you have the people who are the kind of uneducated people who are literally the people who, they're going to their bank or they're going to the credit union because they saw a poster that says, we love to give home loans. That's the lowest information person, right? Then you have this other one that basically they understand the concept of, I need to shop a loan. I want to go find the cheapest loan. And that's, in terms of interest rates or whatever. And that's another way of looking at it. And by the way, not necessarily a horrible way to look at it, but I think that there needs to be another level of looking and shopping for your broker or your lender. How they perform during a transaction is sometimes almost, if not more important than the interest rate. Because literally a bad lender can kill a deal.
Absolutely. I mean, so you want to start with someone who's knowledgeable, right? So that's the
done.
First piece. Done.
If you don't do that, then we really have nothing more to talk about here. You know what I mean?
Exactly. And obviously, you want to work with someone you like, right? And that in your gut that they have your best interest in mind.
Right.
They're
looking out for you.
Exactly. You should look at I call it a core lender, right? So someone who's got a big group of different options and loan programs, payment options. They offer competitive rates, right? Because rates are important because this is what you're going to be paying every single month for 30 years if you have a 30-year fixed loan. And then also they have a solid track record of helping clients with the type of home loan you're seeking, right? So look at testimonials, ask your professional network for referrals, and at the end of the day, just you go with your gut.
It seems like such a shot in the dark kind of way of looking at it, but I mean, you do have to sometimes you get all the information you possibly can, get proof of that person's got a track record, but at the end of the day, do you feel good when you talk to them? Because guess what? You're going to need to feel comfortable enough in the 20th day, 25th day, whatever, to call that person up and tell them sometimes things that they don't want to hear back and forth. And so it's as much an emotional decision as it is a financial one, although the financial one is incredibly important. But you need to have, this is a relationship where, you talk about how an agent, you walk around with them to every house and, they answer your phone calls at 2 in the morning. I believe it or not, I do actually do that. I mean, I don't.
We're gonna test it. Let's see if Tom's awake at 2.
I'll roll over and answer the damn phone. But I will, because it's important, because I'm almost, it's like the Sherpa. You part of it is comforting the client, and so you're going to be making those hard phone calls to that person back and forth and telling them things that, as a broker, you're going to say some things that you're not so, oh God, I've got to tell them this. And they have to also tell you things that maybe they know that it's going to be. So you want a great relationship on top of it. So talk to them, take the time to talk to them, interview them. Really, this is not something where you make one phone call on a Sunday because you just saw a cool house. You really should be talking to people and interviewing them. I had a client who literally put me through a 30 to 45 minute interview, and I loved it because look, I got nothing to hide. I know that what I provide value wise and what I provide as a person is going to be leagues above other agents, right? So they shouldn't be challenged if they won't give you that time. Don't bother with them. You take that time. While we're still kind of in the pre-approval stage, I think it's kind of, let's give the folks some education about the types of loans that are out there, right? So let's take first of all, you hear this a lot, there's, the conventional loan and the jumbo loan. What does that mean?
So when you look at a home loan, first of all, conventional, it could mean different things depending on where you are in the country, right? So we're here in Southern California. So I'll comment on Los Angeles County. You can go to a website and you can find out what information is out there in terms of what your ranges are for a high balance loan or conventional loan. So the information's out there. In Southern California, a conventional loan is a loan that is $417,000 and below. Right? 417 to 625.5, that is a high balance loan. Majority of loans in America fall in those ranges, right? And the two primary purchasers of mortgages are Fannie Mae and Freddie Mac, right? So those are the ones that we directly sell our loans to, and they then package it up and then put it out on the market in the form of securities. Right, so that's a little bit of 101, mortgage 101. Jumbo loans, on the other hand, these are loans that are 625.5 and above, and they also are loans that are originated by outside lenders, private lenders, right? So it can be the big banks like Wells and Chase and Union Bank and all sorts of different companies that are out there, and they have their own guidelines.
Right. So basically, it's you when you have your price range that you're looking for, that's basically where it's the spectrum of where you're falling, basically.
That's right. And then, then there's also government loans as well. There's FHA, right? So Federal Housing Administration, and then you have VA, for veterans.
And interest rates are determined by. I mean, there's a correlation between the conventionals are generally the lower interest rates, because it's more of a higher risk. Is that correct? I mean.
Not necessarily. Okay. So the interest rates are calculated primarily off of the borrower's FICO score. Right. So Fair Isaac, it's your, wherever you see the, freecreditreport.com and all those other companies that are out there, they keep talking about FICO scores. That's the FICO score. And what we do when we run a residential credit report, we are looking at the score from Equifax, Experian, and TransUnion, and we take the middle score. Right? That is your FICO. That is the number we use. And with every single loan and different programs, there's different bands, right? So someone who has a higher FICO score is going to get a lower interest rate in general, right?
Right.
On top of that, we also look at how much the client's putting down, right? So there's a down payment because there's a band on that. So someone who's putting 40% down is going to potentially get a better rate than someone who's putting down 5%. Right. So that's another factor. Another factor would be what type of property. Is it a duplex? Is it a fourplex? Is it just single family residence? Is it a condo? There's all different levels of risk associated with the number of units. And then finally, I'd say is the occupancy. Right. So an investment property will have more risk associated with it because at the end of the day, that person isn't living there. They can just pack up and go. Right. They can, they have their own primary residence and they're buying an investment property. Well, those are the primary determinants. And, when someone asks, how are your rates?
Yeah.
My answer, they're competitive.
Right.
We have to look and see what you're actually buying.
How are you? How are you and how is it that you're buying? Yeah.
Exactly.
Right. So then the other kind of area of loans is the what's the word I'm looking for? But category of loans is it APR? Is it adjustable rate or is it fixed? So go into briefly, we understand that the rate will go up and down and unadjustable, but in a fixed, it's a fixed. But maybe you have some insight in terms of what situations are best for which.
Sure. So when I look at someone who has a quote unquote fixed income, so let's just take someone who's 51 years old, they're an engineer, and they plan on living in that home for 30 years, right? 30 plus years. And they're not going anywhere. They found the home in their dreams. Because they have a fixed income and they want to have predictability in making those mortgage payments, I would probably recommend a 30-year fixed for them, right? I'm not going to recommend a 5/1 ARM for someone who is living on a fixed income. ARMs, they're not that scary, right? So an ARM means adjustable rate mortgage. For certain people and for certain characteristics, it's actually it's a pretty good deal. Obviously, you need to talk to your lender and you need to talk to your financial advisor and CPA, all of the professional parties involved. But when I look at an ARM, I'm looking at this as someone that tells me, you know what, this is a starter home for me. I'm a salesperson and, I can handle the fluctuations, and I know, my income is here, but I know it's going up there. Right. And I know I'm going to live in that home for 3 years. Okay. So maybe I'm not going to put them in a 5, but maybe a 7, right? That might make sense, because what happens is after that 7th year, the rate is going to reset to what the prevailing interest rate is in the market. So, and things change, right? And that's why people look at lenders as sources to help refinance, right? So that's a refinancing opportunity where you have somebody, let's say they started it with that perception that, I'm only going to live here for 3 years, but they fell in love with the place. They put in all these, these great fixtures, and they really fixed up the place, and they love it. They absolutely love the house, and they would rather convert their mortgage from a 5/1 ARM or a 7/1 ARM, and they'd rather have a 30-year fixed, right? So that's when we go through in the process and we refinance them.
And I think that another misconception that I think people have about adjustables, look, it's a preference thing also. I mean, I just know that I prefer fixed. That's just the way that that's just my constitution. But at the same point, if you do have that ability to kind of go separate yourself and go, you know what, this actually is a really good rate. I really think it's going to be fantastic. But one of the things that I think people have a misconception about is that, let's say that, interest rates went up 10% the next year, that your rate is going to go. There are limiters, correct?
There are, yeah. So there are certain, there's certain items where, we have a 226, right? And what that means is the first year, right? So if, let's say you have your 7/1 ARM and it's at 3%, okay? So
go 7/1.
7/1 ARM. So we're talking about a 7/1 ARM. So
no, I'm saying go deeper into what is a 7/1? Like
sure. Oh, okay, that makes sense. Sure. Yeah. So 7/1 ARM. So it's an adjustable rate mortgage. The 7, the first number in the equation, means that your payments will be fixed for 7 years, right? So it's kind of like a 30-year fixed mortgage, because your actual amount that you're paying is fixed for 7 years, right? Provided that you keep that loan the next year, year 8, your loan will now float. What that means is whatever the prevailing interest rates are out in the marketplace, your loan will reset. The interest rate will reset to whatever the spread plus whatever the prevailing interest rates are out there, right? So what that means is potentially your loan could be 5%, right? You were at 3, now it's at 5, right? Could it be 10? No.
That's the key.
It can't be 10, because there are certain limitations when it comes. There's caps. We call them caps, right? So with a cap, a 226 means that in year 8, your loan can't rise more than 2% from the start rate, which is 3, right? So the most it could be is 5, right? The next year, interest rates go to 10. Can it be 10? No. Right? And the reason is because that second 2, remember I said 226? The second 2 is the most it can rise from year to year, right? So again, there's that cap. Year 3, can it go to 10? No, because of the year to year, but also there's a 6, and that 6 is your ceiling. So if you started at 3, the most that interest rate you will ever pay is 9.
Right. So that gives you kind of a little bit of, a better understanding, I think, to most folks out there. It's not like if interest rates go up to 15%, my God, I'm going to take a bath and I'm going to, you are going to be seeing something that could potentially rise, but there are ceilings and there are things that can prevent it from just going nuts.
Right. So. And if someone does not want to subject themselves to just having their fixed period expire, then they have the opportunity to refi.
Yeah.
Right. So they could refi this year, they could refi next year. So it's probably a good idea to look at your ARM and see where you are in the process. There's a lot of people, you do the loan and in 5 years, they're like, no, I've got a 7-year ARM. No, you have a 2-year ARM, right? Because in 2 years, you're going to be subject to whatever the market, whatever the prevailing rates are.
Right. So we're kind of getting to the point where we're going to have to kind of wrap up a little bit. And I think that what we've done here is we've taken you down I kind of see it in 3 different stages of the loan, the life of getting a loan for your home. There's the first part where you're shopping for your agent, really understanding what loans are good for you. The next step we're going to talk about is the actual applying for the loan. And that's going to be on a future podcast, basically taking a look and saying, there's these kind of things you need to look for, the conditions you're going to have to meet, basically what your credit rate is going to do in terms of interest rates. We're going to talk about that later. And then the actual third phase, which is the closing of the loan, to make sure that all the loose ends get tied up. So, but I did say earlier in the podcast that I did want to briefly talk about how a lender can help a seller in terms of making sure that the offers that are being made are actually good offers. So go ahead and talk about cross qualifying. I mean, what's in terms of you, and you do this a lot for your agents.
I do. It's a service, right? So what a cross qualification is, in a nutshell, is Tom is the listing agent or the person who is representing the seller. Okay, so Tom receives all these offers and they all look pretty good, but Tom wants to do his due diligence, right? He's not going to just blindly accept an offer because it's higher or, it sounds good. No, what he's going to do is he's going to say, hey, this is what I've got. This person is putting down 20% and, their FICO is at 790 and they are a doctor and they just started their practice last year. Will you take a look at it? Okay. And then there's another one who is FHA and they're using a down payment assistance program and they're putting down 3.5%. And then there's another one where they're putting 40% down and they work for a major company and they're a salaried employee. Okay. So, and they're all at different price points. So a cross qualification is I, as a lender, will actually call. So Tom will put in the notes. So when he's sending out the counter offers, he'll actually put in the note section, please call Ron Bruno for a cross qualification. Now it's up to the borrower to make that call. So if the borrower is the one that's actually calling me and we're having that conversation, well, that's an opportunity for me potentially to work with that person, right? So I'm going to be congenial and I'm going to help them and I'll ask them who they're working with and what rate are you getting? Most times, if they have a savvy lender, the lender is the one that's calling me. Right. And this, I'm a believer in karma, right? So I'm not out there to snake deals because it comes around and it burns, right? I mean, that's the worst thing you want to have happen is to spend all your time working with a client.
And I think, but let me interject here that you're the buyer. I want them to understand that there's no obligation that they have to go with this person that they're cross-qualifying with, because they might think that, if I go with that person, it's going to somehow make the deal so much sweeter. And it's not necessarily so. I mean, it's really just an extra check that the sellers have put out there to make sure that it's like a stress test to make sure that they should be able to close.
Yeah, absolutely. So what I do in a cross-qualification, so the lender calls me, we have a conversation, and I tell them, okay, can you send me your automated underwriting system report? What does it say, right? So if they don't know what an AUS system is or a report, then I know I'm dealing with a really weak person, a weak lender.
Weak lender.
Yeah. But let's say they have their stuff together and okay, so they send me the automated underwriting system report. I'm looking at that. I'm also going to look at their assets. I'm going to look at their tax returns, and I'm going to go ahead and say, okay, well, tell me what program are you're putting them in. Tell me a little bit more about their situation. Because I make these calls to other lenders when my buyers are out there making offers, I'm buttoned up, and that's what a lot of other lenders are, because I mean, we're on the spot, right? So we are out there presenting our clients in the best light we possibly can. So from a cross qualification standpoint, yeah, it's we're asking the tough questions, whatever, but it's with a colleague. It's someone in the industry, right? But it is a necessary step, right? Because the last thing you want to have happen is say, oh yeah, they're fine, go for it. And then all of a sudden they get an escrow and then, there's something that blows up. If it was something that was easy to pick up by just doing a little extra due diligence, well, that's not a really good service.
Right. I mean, if that lender calls, if you talk to the lender and he's not speaking the language, it's a good indication that maybe what other holes are in this deal.
That's right, because the loan officer is the one that's going to be guiding the process the whole time.
Right.
And if they don't know what an automated underwriting system report looks like, or they don't know their stuff, well, I'm going to report that as well.
Yeah. Absolutely. And then on the agent's standpoint, the listing agent's standpoint, we then take that information, everything that we've heard, and we basically are judging the different strengths of the different offers. And if we hear that that's not only they're not cash, not only they're not pre-approved or whatever it is, but they also have a loan guy that just sounds like he doesn't know what the heck he's talking about, it's not going to give the sellers the confidence to really go with that offer.
So yeah, exactly. So when you look at representing, so a lender representing a buyer in the transaction, well, what we're trying to do is we want to present you in the best light. So just like Tom writes, when Tom's representing a buyer, just like, he puts together the nice letter, has pictures of the family, and
we've been told not to do that anymore, by the way.
Oh, interesting.
No, because when you think about it, you can't do that anymore. There used to be that you were going to get a leg up by sending a photo
right
to the other side. Say, look at this lovely, beautiful family. But guess what? It's a photo, and guess what the photo shows? It can show race. It can show, and then basically they can get into trouble later on down the line. Liability, basically say, well, we showed the picture and we were X, Y, or Z, and you said we didn't get the deal because of that. So
we're
being told that is not.
But you could still do letters, right?
You definitely can do letters. It's just anything that visually shows what a culture or a disability or something like that.
See, folks, you're learning things all the time. I'm learning things. I had no idea. I thought the picture was a really nice thing, but totally get that.
But what you're saying is dead on in terms of one of the things that when you're shopping for your lender, one of the things you should be asking them is, well, what do you do to help us get this into our offers accepted?
That's right. So, when Tom and I work together, it's not that I issue that pre-approval letter and then, hope and pray and, in 2 months, all of a sudden we're going to open escrow. No, we're involved every step of the way. And one of those aspects is, let's say I pre-approved a client and they're a professional and they're pre-approved with 20% down for $1 million home. Okay. And they're out there shopping and Tom's showing them all these great properties and they happen to find a home that's valued at $850,000. Okay, so I have my pre-approval letter that I sent to Tom that says they're pre-approved for $1 million. Is Tom going to submit that pre-approval letter for $1 million? No. Why give away all your cards, right? Why show your cards to the other agent and say, I can come up $150,000?
Yeah, because guess what? They'll ask.
They will.
They'll be playing you against other offers until basically it's like, well, I know that guy can go up to $1 million, so let's see if I can, twist it out of them.
Exactly. And
by the way, it's good to know that you can tell them that there's room. That this isn't all they're worth, because that would also kill it. But you also don't have to show all your cards either.
That's right. Yeah. And I sometimes do receive calls from the other agent. So they may not call Tom, but they'll call me because my name's on that pre-approval letter. And they'll say, okay, does your client have room, right? Because they don't want to have to, keep issuing pre-approval letters for every counter that's going in there. And it's okay for me to say, yes, there's room.
Yeah.
Right. And that's the okay symbol saying we're doing our due diligence and we've done our homework and there's flexibility, but we're not going to be giving away all our cards. Right. There's no sense in doing that. Another thing to keep in mind is if you were out there looking for homes and let's say the client's FHA approved, right? Yay. Okay, great. So out there looking at homes. Well, I need to know if Tom's showing them a condo, right? Why? Because FHA has a guideline that you can't get FHA financing if the condo association is FHA approved, right? So these are things that I need to know on every single offer that's out there. What the terms of the deal look like? What is the property? What's the occupancy? Because I got to check it back with what's out there.
And we will be going more into depth into that when we get into the future mortgage podcasts, because this is, I think that, look, everyone knows that this is one of the most primarily important aspects of purchasing a home and selling a home. Even it's the mortgage, picking the right mortgage lender, understanding the process. So we're going to be going much more deeper into this. There's going to be a part 2. There's going to be a part 3. But I think that's about all the time we've got today. So we'll give you some time to let this stuff sort of sink in, and part 2 will be coming along sometime in the very near future. Thank you, Ron, for being an awesome guest.
Oh, it's been my pleasure.
With lots of great information, as always. I want to thank him and his company, Guaranteed Rate, for letting us record our podcast in their lovely offices here in Pasadena. Why don't you go ahead and give the folks the places where they can contact you if they want to ask you any more questions or get more information?
Yeah, absolutely. So you can send an email to me, Ron, at clarifiedrealty.com. You could also reach me on my cell phone, which is area code 310-804-8243. You can text me as well.
Great. Awesome. And for you guys out there listening, just a reminder, I want to encourage all of you to interact with other listeners, and let's make this a truly amazing and useful experience for everyone. If you want to get more information or ask me questions, please email me at tom@clarifiedrealty.com. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. I'm on Snapchat, Twitter, and Instagram as well. My handle for all 3 of those are at Clarified Realty. And please check out our Clarified Realty podcast page on Facebook, if you please. I beg of you, please leave feedback and reviews on iTunes or in the comment section on our page. I definitely want to see everything you guys have to say, good or bad. My amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs. And please go check them out and like them on SoundCloud. We'll also leave a link to the song in the credits if we can. They rock so freaking hard, I think my brain is going to come leaking out of my ears a little bit. Go check them out for some amazing tunes. And just a little disclaimer, Ron and I are licensed by the California Bureau of Real Estate. My license number is 0171-5353. Ron's is
Guaranteed Rate, NMLS 2611, NMLS ID 558706.
The advice we give is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. And that's about it. Ron, you good?
Fantastic.
Great. Well, thanks for coming by, everybody. And remember, the greatest thing you can ever do is make someone feel at home. Take care, and we'll see you next week.